a little bit of good news and a little bit of worrisome news. So we obviously moving the markets, global growth, trade, and the Fed. But you have a message on global growth. It's not going to be as strong as people think. Give us your outlook right now.
So our outlook this year is slightly muted. I mean, in the U.S., we're expecting growth in 2019 to be around 2%. We're expecting growth of about 1% or so in Europe, and we're expecting China to slow down to about 6%. And there is a possibility that you actually get a print during one of the quarters in China that actually has a 5 handle on it.
This kind of worries me a little because essentially this is a lower forecast than 6 months ago. The EU had this. The Bank of England had depressing commentary last week. So it seems like the United States is one of the only real engines of global growth out there, certainly on the earnings front. What does that mean for the stock market?
I mean, the stock market's had a good run so far this year after, the close to a bear market at the fourth quarter of 2018. But I think if we look forward for the next 10 years, our expectations around U.S. equity markets is about 5% median annualized return over the next decade.
That's lower. So you've lowered the numbers.
5 years
for 10 years.
That's
the
for
next
10 years.
years.
The next 10 years, 5% annualized. 5 years ago, we'd have been somewhere around 8%. So our expectations have clearly come down when it comes to the U.S. equity market expectations.
I've got a little worry about the market right now because we've got this 0% earnings growth crowd. We've got earnings recession crowd out there saying we're going to get negative growth for 2 quarters. If you're at 0% earnings growth for 2019, the market is really expensive right now. It's like 17 times forward earnings. 0% earnings growth, 17 multiple. That doesn't seem like a good idea for the markets right now.
No, I mean, but if you go back and you look at where we are right now relative to the beginning of 2018, at the beginning of 2018, we're like 18 and a half times forward earnings. So things have cheapened up a little bit. But again, to your point, we think we're at the high end of fair value and, again, muted growth going forward.
Are you expecting 0% earnings growth? I mean, where are you on the S&P for this year?
We think the earnings growth this year is going to be the mid-single digits.
The mid-single digits. Okay, so you're much more optimistic.
A little bit more optimistic than what we see these folks that are expecting 0% growth over that time
frame. You had a very interesting point. In these kind of environment, fees really matter. Of course, Vanguard is famous for always pounding away. Fees always mattered. You showed a great chart that showed bond funds. When you extract the cost, the fees of bond funds, almost no managers ever outperform, number one. And number two, the alpha goes away. There's virtually no outperformance. The whole point being, when a low return environment, fees matter tremendously and go as low cost fees as you can possibly have.
Absolutely. I mean, when we looked at it, we looked at intermediate term bond funds, intermediate term government bond funds. We also looked at corporate funds. And for intermediate government funds, once you take fees into consideration, that alpha all disappeared. And most of the alpha, when it came to corporate bond funds, also disappeared, but there was still some marginal amount that was left over.
So the key is low cost is critical, whether you're dealing with active funds or passive funds. And of course, Bogle's central insight is most of the time, active fund managers don't outperform.
That is correct.
Okay, let's talk about the recession. Everybody wants to know, is it going to happen? Vanguard's outlook, recession in 2019, yes, no?
No. No, we're not. We upgraded our risk of a recession in 2019 because of policy uncertainty from 30% to 35%. We see the risk rising as we go into 2020, where we expect it to be somewhere between 40 to 50% chance of recession in 2020.
In 2020, 40 to 50% chance. Okay, inflation, you're still relatively muted. I heard you say here 2% for US?
2% in the US, that's correct.
And Europe?
About 1%. 1.5%, and the same thing for Japan, about 1%.
What does it, before I let you go, 5% returns now. All of us used to talk about 7, 8, 9% returns. What does that mean for people going forward? How should people adjust their outlook?
It's a great question. I think investors need to keep in mind that, look, we do have lower expected returns going forward. So, again, you're probably going to have to save more, save longer, and ultimately control what you can control, and that's cost.